In 1690s London, a cup of coffee cost more than a day's wages, and it sparked the first financial panic in history. Most people think the stock market crash of the 1690s happened because traders were reckless. They'd gathered in coffee houses, drunk on caffeine and greed, and collectively lost their minds over a company called the East India Company. The story goes, no regulation, no transparency, pure speculation fever. It's a tidy explanation. It makes sense, and it's almost entirely backwards. Let's start with the accepted story. In the 1680s and 90s, London's coffee houses became the unofficial stock exchanges. Jonathan's Coffee House, Garraway's, Lloyd's, these places weren't selling just beverages, they were selling information. And where there's information about money, there's speculation. Brokers would gather, pass around handwritten stock certificates, and trade shares in the East India Company with almost no official oversight. Coffee itself was the luxury good. A single cup, we're talking about a small, dark, bitter drink, cost between sixpence and a shilling. For context, a laborer earned about a shilling a day, so you were paying a day's wage to sit in a smoky room and watch other people get rich, or so you thought. The East India Company itself wasn't new. It had been chartered in 1600, but by the 1680s, something shifted. The company began issuing stock more aggressively. Suddenly, ordinary merchants, not just the wealthy elite, could own a piece of the trade routes to Asia. Prices climbed, rumors circulated, and yes, people panicked and bought. By 1692, the bubble burst. Stock prices collapsed, fortunes evaporated, coffee houses that had been buzzing with deal-making fell silent. Parliament was horrified. They'd seen what unchecked trading could do, so they did what governments do. They blamed the traders and the venues. The coffee houses became synonymous with recklessness. But here's where the real story peels back. The crash wasn't primarily about greed in coffee houses. It was about something far more structural. The English government was broke. In the 1680s, King William Roman III needed to fund wars. He needed money fast, so the government itself encouraged the East India Company to issue more stock. The Crown was the original speculator. It pushed the company to raise capital by flooding the market with shares. This wasn't irrational behavior by coffee-fueled traders. This was policy. The government needed military funds, and the stock market became a tool to extract wealth from ordinary people who thought they were investing in commerce. So the price kept rising, not because the company was actually becoming more profitable, but because the government kept issuing more shares and talking up the venture. When prices finally peaked and reality set in, the collapse was inevitable. The coffee houses didn't cause the bubble, they just hosted it. What's fascinating is what happened next. Parliament didn't regulate the government's ability to manipulate stock markets. They regulated the coffee houses. They restricted trading, clamped down on brokers, and tried to centralize stock trading under official control. The actual source of the problem, government-driven inflation of securities, went untouched. The coffee houses themselves survived, but their role changed. They became less about trading and more about information sharing. By the early 1700s, a new institution emerged, the official stock exchange. Trading moved indoors under rules with official brokers. It looked more legitimate, but the core mechanism remained the same. Here's what this tells us about the 1690s crash. It wasn't the first time ordinary people got caught holding inflated assets. It wasn't the first time a government used a market to raise funds by encouraging unsustainable speculation. And it wasn't the first time regulators blamed the venue instead of the policy. The coffee houses were simply the medium. They were where information flowed, where prices were discovered, where ordinary merchants could access markets that had previously been closed to them. The medium got blamed for the message, and that blame stuck for centuries. So why did coffee houses become synonymous with financial chaos? Because they were visible, they were social. They were where the common person could see wealth being made and lost. Parliament needed a villain, and the coffee house was perfect, loud, crowded, full of common traders making their own decisions. The real culprit, government-driven asset inflation, was harder to point at. It required admitting that the Crown had orchestrated the bubble to fund its wars. Easier to blame the traders. Easier to say the problem was speculation and greed. Easier to regulate the venue than to regulate the policy. And that pattern, blaming the mechanism instead of the policy, echoes forward. In 2008, we blamed Wall Street traders, we blamed the rating agencies, we blamed the complexity of derivatives. All true, but the underlying policy that encouraged reckless lending, that took far longer to examine. The coffee house panic of the 1690s teaches us something uncomfortable. When prices rise faster than fundamentals justify, someone is usually pushing them up on purpose. Sometimes it's traders acting rationally within broken incentives, but often, more often than we admit, it's policy itself. The coffee houses didn't panic the market, they just made the panic visible. And sometimes, the best way to avoid blame is to make sure no one can see what you're doing. That's a lesson that transcends the 1690s. That's a lesson about how power works. Understanding financial history isn't just about knowing what happened. It's about recognizing the patterns that repeat, the scapegoating, the policy obscured behind mechanism, the way visibility becomes a liability. The next time a market crashes and someone blames the traders, it's worth asking, who pushed the prices up in the first place? This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to see the patterns that repeat across centuries of market manias and understand the real machinery behind the next one. This video is for educational and informational purposes only and is not financial advice. Always do your own research.